Europe's economy. Here we go again, folks. When you hear that the European Central Bank, ECB, is preparing for speedy interest rate cuts, you know the economic situation is at a point where, let's be honest, it's not just the weather that's gloomy across the Eurozone. In fact, we're looking at the potential for another serious economic miscalculation. Today, I'll break down not only why the ECB feels pressed to act as it does, but also what deeper structural problems have forced the situation to boil over like this, leading to aggressive rate cuts that I'm sure will invite plenty of unintended consequences. Now, before we start believing everything will work out just fine because, hey, they're the ECB, let's remember some cold, hard facts. Europe's 20-nation economy is wobbling. It's facing slower than expected growth, an inflation battle that is not yet won, spiraling wage pressures, and worsening geopolitical headwinds. So, keep watching if you want to understand why, despite their best intentions, the ECB's latest moves might just compound these problems, and why you should care even if you're not deep into macroeconomic policy. Trust me, by the end of this, you'll see how it all ties together. Everyone loves lower borrowing costs, don't they? From households upgrading to larger homes with more appealing mortgage rates, to businesses leveraging cheap debt to grow their operations, to governments feeling relieved about lower yields making their massive debts more manageable. And yes, in principle, cutting interest rates can indeed give a much-needed lifeline to struggling economies, especially one like the Eurozone, which is teetering on the brink of outright stagnation. The ECB is expected to slice its deposit rate by a quarter point in each meeting, starting next week and potentially stretching through to March, bringing the benchmark rate down to 2%. Many analysts are saying that by cutting rates faster, the ECB is making the growth agenda clear. They're determined to jolt some life back into the comatose Eurozone economy. But here's the problem. Interest rate cuts are like a beloved remedy handed out with abandon, even when the symptoms indicate that deeper issues are afoot. Right now, inflation is hovering around the ECB's magic target of 2%, down from those gruesomely higher levels we saw in recent years. Problem solved, you might think. But the economy is far from healed. Inflation may be slowly retreating, but the structural problems causing years of tumultuous price growth persist. Below the surface, storm clouds are still brewing. Inflation may have dipped to 1.8% in September, below that psychological 2% level for the first time since 2021, but let's not break out the champagne just yet. As any credible economist will tell you, inflation hikes usually mask deeper, more pervasive challenges. Even though the ECB looks poised to start a spree of rate cuts to supposedly aid the economy, it's critical to ask whether inflation can really be pegged at bay with a quick reduction to neutral interest rates. A small majority, or 55% of analysts, according to Bloomberg's survey, believe Europe could even undershoot the inflation target, finally reaching a soft landing after a tense few years, but not so fast. There's still about 45% of doubters saying inflation could rise again. And even those within the majority aren't giving full assurance that victory has been achieved. Just managing to bring inflation down doesn't erase the structural lethargy that persists across Europe's economic ranging from Germany's industrial slowdown to Italy's mammoth pile of public debt. Notice something weird though. About 2/3 of survey respondents are predicting success for the ECB's ability to bring inflation to 2% and stabilize it. But fewer people are convinced that by the end of 2025, Europe is going to experience a true economic expansion. Why? Because they're all too aware that wage growth remains robust even as growth falters. A record-low unemployment rate coupled with rising wage demands, as we've seen with German public workers demanding an 8% increase, makes it clear that inflationary forces haven't been smothered for good. They are merely simmering for now. This is the ECB's main problem. Wage inflation and tight labor markets are contradicting its reality. If wages keep growing unchecked and productivity stagnates or declines, it leaves room for more inflationary creep down the line. It's like fighting a snake by chopping off the tail. Serious issues remain at the heart. This leads us to perhaps the most troubling dynamic at play. Yes, the ECB is working very, very hard to find a middle ground between taming inflation and supporting growth. But balancing these forces simultaneously is the equivalent of eating your cake yet hoping to somehow save it for later. It's a mismatch that suggests deeply rooted contradictions in monetary policy logic right now. I like how one economist from ABN AMRO, Bill Divany, phrased it. The ECB's main challenge continues to be simultaneously managing the downside risks to growth against persistent upward inflationary pressure from high wage growth. Here we see the ECB standing on shaky ground, caught between two colossal macroeconomic forces trying to push them over the edge. But wait, there's more. Beyond the typical inflation growth balancing act every central bank faces, Europe is now dealing with a fragile external environment. A potent stew of geopolitical uncertainty. Hello? Donald Trump 2024? And potential energy price shocks stemming from escalating Middle East conflicts. With escalating tensions in Gaza and rising oil prices likely hitting Eurozone economies through more expensive energy imports, Europe may be gearing up for inflation to return just as the ECB is settling into its rate-cutting spree. But of course, a global slowdown in demand, from China all the way across the Atlantic to the US, could mute the impact that higher oil prices might otherwise have. But hey, a recession tending toward disinflation is hardly the recovery plan anyone would want. Let us not forget how monetary policy divergences between major central banks can spawn unintended consequences. Even as the ECB trials a series of rate cuts, the US Federal Reserve has taken the opposite approach in recent months, embarking on its own monetary easing campaign with a half-point cut. A huge step after years of tightening to combat inflation from its own bout with runaway price increases. But while European policymakers applaud the Fed for leading the way, the real challenge they face is how their decisions may pull in opposite directions unless aligned with the global landscape. Here's the unfortunate reality. If the ECB pulls the lever too hard, it could wind up leaving Europe more vulnerable to external economic pressures dictated by the US, where growth prospects look marginally better. Essentially what we have is Europe going for a softer cushion, but the US building sturdier walls. And that's going to matter big time when trade, investment flows, and the euro-dollar exchange rate come into play. If global financial stability wavers due to ongoing divergences in policies, Europe could find itself caught out in the open, facing unintended forex fluctuations, export market shifts, or even capital flight, all while fragile growth aspirations get derailed at home. As the euro weakens, consumers and businesses across Europe will bear the brunt of any fallout, since import costs will soar, and they're already struggling with high energy prices and ongoing sluggish recovery prospects. Many commentators are quick to point out that household spending and trading investment play a critical role in revamping growth. But how can consumers be expected to spend when their real disposable income is continuously eroded by inflation and rising energy and housing costs? Europe loves talking about green shoots and optimistic recovery forecasts, but we're seeing the opposite unfold in reality. Hope for a double whammy recovery driven by consumer spending and investment growth is sinking fast. Rising interest rates strangled lending, but when rates drop, do not expect a quick burst of exponential demand. No, this is not a repetition of the post-pandemic recovery rally. By now, the problem should be abundantly clear. Multiple crosscurrents are battering the Eurozone economy. ECB policymakers, though proactively trying to evolve with trends, are at risk of underestimating long-term structural problems, not to mention external shocks that could easily reroute the trajectory toward inflation and growth once again. And while Bloomberg's survey results trigger top headlines promising quicker bites at rate cuts, the lingering doubts raised by respected economists, businesses, and traders indicate that there is no silver bullet to Europe's set of compound dilemmas. Against this backdrop, the overall optimism in these enhanced rate cuts being the elixir Europe needs might, in fact, be the very thing that blinds the ECB and markets to the real long-term consequences at play. All in all, Europe is standing on uncertain footing, wrapping a bandage around a far larger structural wound. Until policymakers go deeper and reform systemic imbalances, whether that be labor markets, wage structures, or energy dependency, rate cuts will do little more than kick the can down economically turbulent roads. Debt, inflation, wage pressures, geopolitical risks, and energy volatility run too deep for such superficial monetary fixes to have a lasting impact. Let's dissect those structural problems and unveil the domino effects that we might soon see, causing more harm than good to an already fragile Eurozone economy. Sure, rate cuts spark the illusion of quick-fix solutions. But remember, the ECB is facing deeper, more systemic issues that lie beyond what monetary policy can shift. So, what are these structural challenges and why do they matter so much? 1. Labor market imbalances. Rising wages, stagnant productivity. The Eurozone labor market is, at first glance, a sign of strength. Unemployment rates sit at record lows, and wages are rising sharply. But there's a catch: productivity remains flat, growth is hovering near the bottom of the tank, and businesses are wrestling with a complete mismatch between wage hikes and economic output. As we mentioned earlier, German public sector workers demanding an 8% wage boost underscores the problem. Pay increases well above inflation redeposit wage-driven inflationary pressures back into the system, even if headline inflation appears to be subdued for now. The root of this issue? Europe's relatively slow progress in productivity growth compares poorly to economies like the US or South Korea, which have historically managed a more balanced relationship between wage growth and productivity. The mismatch between what employers are paying and how much output workers are delivering creates cost pressures for businesses without corresponding productive gains. This leads to a nasty spiral. Companies raise prices, reinflating consumer price indices. Competitiveness drops, especially for export-driven economies like Germany, and demand dwindles both domestically and abroad. If firms continue passing these wage costs onto consumers, the ECB will struggle with sustained core inflation that can easily disrupt its well-laid plans of modest deflation. 2. Europe's energy dependence and the ESG transition. With the energy crisis still in motion, Europe's unholy dependence on imported energy, especially natural gas, can't be overemphasized. Sure, we've seen some short-term relief in energy prices, but geopolitical risks, primarily involving Middle Eastern tensions or escalating conflicts in Gaza, have the potential to send oil and gas prices rocketing upward once again. Considering Europe's ongoing transition towards green energy, there's a conflict brewing between the desire for sustainable development and the reality that fossil fuels still anchor the continent's energy needs. Accelerating investments into clean energy may offer long-term benefits, but for now, Europe will bear painful costs. This raises another pertinent question. As energy prices remain volatile, will the ECB's rate cuts even be enough in the face of external supply shocks? 3. Aging population and shrinking workforce. But wait, it gets worse. If you think rising wages and inflationary creep are the only difficulties, just factor in Europe's demographic time bomb. The Eurozone faces a shrinking workforce and an aging population that places heavy financial burdens on social safety nets and pension systems. This has broad implications for fiscal policy too, as European governments balloon their public spending just to keep their aging populations afloat, which leads to increased debt burdens. This demographic shift puts more pressure on Europe's productivity. As older workers retire, the lost experience and know-how aren't being replaced by a sufficient number of young, skilled workers entering high-productivity roles. This sets up a low-productivity trap scenario that worsens inequality and stifles economic dynamism. 4. Business investment is lacking. For businesses, lower borrowing costs traditionally lead to more investment in R&D, equipment, and innovation. However, with confidence low, businesses in the Eurozone, particularly in manufacturing-dependent Germany, remain reluctant to commit to large expenditures. They are caught in a cautious zone where the broader instability of the global market, due to trade tensions, geopolitical risks, and supply chain fragility, hinders their growth outlook. When private sector investment falters, the short-term benefits of lower rates evaporate. Real GDP growth loses its forward momentum. In this light, simply lowering the cost of borrowing offers a temporary respite to businesses but demands far more in terms of structural reforms to actually bring renewed confidence into the equation. Many firms are wary because of recent years' jitters, COVID-19 dislocations, the Russia-Ukraine war, supply chain problems, and now the specter of slower growth globally have scared off the willingness to splash capital on innovations. At this point, with lower investment rates across the board, how can we expect Europe to achieve real growth in actual productive capacity? 5. Geopolitical vulnerabilities, exposure to external shocks. Then there's the elephant in the room, geopolitical instability. Respondents in the Bloomberg survey pegged Europe's biggest risks not to inflation, but to geopolitical uncertainties. Just look at the chaos in the Middle East or the well-documented political movements across the Atlantic, like the looming reappearance of Donald Trump on the U.S. political stage. Both disruptions hold the very real possibility of throwing entire global markets into new rounds of volatility, potentially upending Europe's hopes of navigating safely through calm waters. A return of Trump could unravel the delicate balance of global trade, as U.S. businesses shift focus or alter trade policies further toward protectionism. The Eurozone is deeply interconnected with global demand chains, especially in the manufacturing and industrial sectors. Any major trade realignment spurred by protectionist U.S. policies would rock European exports and worsen the dependency of Europe on already compromised trade from emerging markets like China, which itself is grappling with slower growth and a popping property bubble. Moreover, Growing tensions in the Middle East raise the risk of energy supply disruptions, which would especially hurt Europe's industrial heartlands and lead to pricey energy imports cascading down to the consumer level. Don't forget that essential goods like fertilizers and many manufactured products remain tied closely to fossil fuel prices. Hence, geopolitical chaos, which is inherently unpredictable, has a critical power to derail these ECB efforts to stabilize the economy via rate cuts alone. Let's talk a little about fiscal policy. Regulatory dynamics and government spending measures have always intertwined with monetary policy. In moments of fiscal prudence, central bank interventions play a critical steering role. We've seen this after the global financial crisis or during the euro debt crisis, where ECB actions supported bond markets, mopping up sovereign debt left and right. But now, despite soft proclamations, Eurozone's sovereign debt levels are again soaring to new highs, worsened by fiscal authorities responding with pandemic-related expenditures, higher social entitlement spending, and green transition budgets. Germany's infamous debt brake is cracking under the weight of market forces in 2024, leading to heavier sovereign borrowing. These are fiscal excesses that will force governments to tally up higher public debt, already exceeding the Maastricht Treaty's 60% debt-to-GDP ratio in most member states. In this environment, fiscal policy is limiting what the ECB can safely do with its primary tool, interest rates. The spillover from bond markets is enormous. Central banks can't simultaneously prop up bloated public debt forever while also inspiring faith through rate cuts meant to spur growth. Despite efforts by the European Central Bank to use interest rate cuts as a lever for growth, the real issues that Europe faces aren't ones that can be fixed with monetary policy alone. Wage price spirals, demographic stagnation, subdued productivity, geopolitical vulnerabilities, and a looming energy crisis all paint a much darker picture, one that demands bold structural reforms from fiscal and national authorities. The ECB finds itself in a precarious position, with diminishing returns from its rate-cutting strategy. Even if interest rates do fall to neutral levels by the end of 2025, this doesn't address the deeper crises plaguing the Eurozone. Solving these structural issues requires reforms to labor markets, energy policies, fiscal responsibility, and geopolitical resilience. Unfortunately, these are far harder, longer-term fixes that can't be solved by tweaking interest rates alone. Without these systemic changes, the ECB risks falling behind the curve, reacting to symptoms, inflation, while ignoring the broader sickness that's causing Europe's stagnation. Brace yourselves for more economic turbulence ahead because, make no mistake, cutting interest rates is no magic bullet. Structural reform, industry-wide innovations, workforce adaptation, and fiscal responsibility are the real answers to Europe's dim economic future, not short-term rate adjustments by central bankers. And to circle back to the initial point, don't let those optimistic headlines fool you. A fast-paced interest rate cut will only buy temporary relief and likely set the Eurozone up for bigger problems down the road.